Well, we're kind of taking a spin-off of our last video, which was episode number 4. We're in 5 now. Love to show everybody what Bob does with his consultative approach when somebody calls and needs to know not only if they qualify, but how much they qualify for.
Right.
Could you do us a favor and walk us through that process?
I'd love to show you that.
I'm going to step back here
okay,
and
great.
Be a photographer.
So oftentimes Tim will call me or Byron or Sonny, anyone, and say, I'm working with a buyer, but they don't know how much they qualify for. They need to be pre-qualified. And so I want to show you how I do that so that you'll understand it. If you're a first-time home buyer, this might be really helpful for you. What you might want to do is, as you're watching this video, you might want to stop it from time to time and follow through and do this for yourself. So sometimes I'm face-to-face, sitting at a table with someone. Frequently, more often than not, I'm on the telephone. So I'll say to the person on the telephone, get a piece of paper and write this down. At the top of the piece of paper, write a line, and underneath it, write GMI. That stands for gross monthly income. That's your income before taxes on a monthly basis. Then I tell them underneath that, write 28% equals, and a long line. And then underneath that, write 36% equals, and a long line. And then I'm going to explain how I do that. So I'll come up with an example. I used an example of a couple who makes a salary of $85,000 a year. So 85,000 divided by 12 gives us, excuse me, a gross monthly income of $7,083. That's their gross monthly income before taxes. So that's what we work on qualifying. So what these numbers represent, 28% is the housing expense to income ratio, or first ratio we used to call it. So that is the amount that they can spend on a mortgage payment. So we take 7083 times 28%, and that works out to 1983.24. 1,983.24. That's how much their mortgage payment, principal, interest, taxes, and insurance can be on a house, and they would qualify. But now we have a second ratio, and that's their total debt to income ratio. So that's the mortgage payment plus all their monthly debts. Now I'm not talking about cable, and I'm not talking about home, maybe their rental insurance, something. What I'm talking about is their consumer debt, credit cards, auto loans, student loans, any debt that they have. And that number is 36%. So 7083 times 36%, that is $2,550. So those are the numbers we need to know in order to qualify a borrower. So the difference between 1983 and 2550 is $567. So in order to qualify for this amount, as this is structured, the borrowers can have no more than $567 a month in debt. And that's for credit card minimum payments, their student loans, maybe they have a car loan, whatever. That's what it comes down to. These numbers are valid if they have $567 or no more than $567 a month in debt. So let's assume for this discussion that that is true, that they only have $567 a month in debt. So then this number, 1983, is a valid number. That's what they can spend. Now what I need to do is determine how much of that can be used for principal and interest on the mortgage. So I have to work backwards at this point. So I have to reduce this number by what I think is valid for taxes and insurance. So let's say I've talked to Tim and he's told me, how much the tax, let's say the taxes on the house they're looking at are about $4,800 a year, that's $400 a month, and I'll assume $1,200 a year for homeowners insurance, so that's $100 a month. So I'm going to reduce this number by $500. So I'm taking the maximum housing expense at $1,983 and reducing it by $500 for the taxes and insurance. And what I'm left with is the magic number. It's $1,483. That number is how much a borrower can spend on the loan for principal and interest. So then I can plug in an interest rate and determine, based on that number, how much of a mortgage they can get. So today, it's just after St. Patrick's Day. It's March of 2015. Interest rates today are about 3.75% with 0 points for a 30-year fixed rate mortgage. So if a borrower can borrow $1,483 at 3.25% for 30 years, that would allow them to get a mortgage based on that for $321,223. So $1,483 at 3.75 for 30 years buys that much mortgage. And then you would add whatever you have for a down payment to that number. So if you were 20% down, that would be like a $400,000 purchase. So that's the basics of qualifying a borrower. That's how I do it. That's how I've done it always, and that's the best way to qualify a borrower for a mortgage.